I've been adding just £25 a month into my child's junior ISA, and in this video I'll show you exactly what that's turned into after 6 months, how it's performed, and how it compares to the S&P 500 and FTSE 100. Welcome back to Effortless Investor, the channel focused on realistic, long-term investing with small, consistent contributions. If that sounds useful, you're in the right place. As always, this isn't financial advice, just me sharing my own investing journey. Before we look at the performance, let me quickly recap the plan behind this junior ISA. This is my child's junior ISA, and the goal here is very simple: to invest consistently over the long term using small, manageable monthly contributions. I'm adding £25 per month, every month. Nothing clever, nothing complicated. The idea is to let time and compounding do the heavy lifting over the next 18 years. I chose £25 deliberately because it's an amount that feels realistic for a lot of people. It's not about trying to maximize returns in the short term. It's about building the habit and staying invested. The junior ISA is held with Hargreaves Lansdown, and the money is invested in a globally diversified fund rather than individual stocks. That keeps things simple and appropriate for a long-term child's portfolio. So the benchmark for success here isn't whether we beat the market every few months. It's whether we stay consistent, keep costs low, and give this money the best chance to grow over time. With that in mind, let's take a look at how it's actually performed so far. So far, I've been doing this for 6 months. When I opened the junior ISA, I needed to add an initial £100 lump sum. And since then, I've been adding £25 at the start of each month. So over the last 6 months, that's 6 £25 contributions, which comes to £150 in monthly investing, plus the initial £100, so £250 invested in total. Other than that opening deposit, there haven't been any extra top-ups or changes to the plan. It's been the same £25 every month since. I think it's important to be clear about that, because transparency matters, and it also keeps expectations realistic. With that in mind, let's take a look at where the junior ISA is actually sitting at now. So with £250 invested in total, as of today, the portfolio value is £271.36. That means there's an unrealised gain of £21.36, which works out to a total return of 11.35% over the 6-month period. Now, that return hasn't come in a straight line. In June, the portfolio was up 3.89%. July added another 2.65%. August was a bit quieter at around 1% gain. September picked back up with a 2.18% gain. October was one of the stronger months at 3.83%. And then in November, we saw a small pullback of about minus 2.2%. That mix of positive and negative months is exactly what you'd expect when you're invested in the market. And it's a good reminder that short-term ups and downs are completely normal. Overall though, after 6 months, we're sitting at a total return of 11.35%, which I think is a solid and realistic outcome from such a small, consistent investing plan. Before we move on, I want to quickly show you what this junior ISA is actually invested in. I'm using the iShares Developed World Index Fund, specifically the Class D accumulation version. In simple terms, this fund tracks developed markets around the world, so you're getting exposure to hundreds of companies across the US, Europe, and other developed economies, all in a single investment. The reason I like this fund for a junior ISA is simplicity. There's no stock picking here. It's broad, globally diversified, and very hands-off. The annual fee on the fund is just 0.12%, which is low and really important over an 18-year time horizon. It also has a dividend yield of around 4%, and because this is the accumulation version of the fund, those dividends are automatically reinvested back into the fund. Over the last 5 years, the fund has averaged returns of around 16.2% per year, and while future returns aren't guaranteed, it gives a good idea of how global equity markets have performed over time. For a long-term junior ISA, that combination of diversification, low fees, and automatic reinvestment is exactly what I'm looking for. So let's put those junior ISA results into a bit of a wider market context. Over the same 6-month period, the junior ISA is up 11.35%. If we look at the S&P 500 over that same time frame, it returned around 13.06%. And the FTSE 100 returned roughly 9.87%. So compared to those two markets, the junior ISA has underperformed the S&P 500 slightly, but it's outperformed the FTSE 100 over the same time period. That's exactly what you'd expect from a globally diversified fund. You're not trying to fully match the strongest market in any one period, but you're also not overly reliant on a single country or index either. It's also worth remembering that this isn't a perfect comparison. The junior ISA is spread across multiple regions, and it benefits from pound cost averaging rather than a single lump sum investment. The main takeaway for me is that the junior ISA has tracked the broader market pretty closely, which is exactly what I want from a simple long-term setup. So the next thing I want to look at is whether this junior ISA is actually on track to hit the long-term goal. When I set this up, I used a projected annual return of around 11.5% as a rough guide, not as a guarantee, but simply as a planning assumption. After 6 months, the junior ISA is up 11.35%, which puts it just slightly below the annual projection, but very much in the same ballpark. That doesn't mean we're ahead or behind in any meaningful sense. It just tells us that so far things are broadly tracking as expected. What matters much more than any single 6-month period is whether we stay invested, keep contributing consistently, and let compounding do its job over time. If returns are higher in some years and lower in others, which they will be, that's completely normal. So from a pacing point of view, I'm happy to stay the course and keep doing exactly what we've been doing. So in terms of what I'm doing next with the junior ISA, the plan is still very simple. I'm going to keep adding £25 per month and leave the investment exactly as it is. There's no rebalancing, no switching funds, and no attempt to react to short-term market movements. At this stage, consistency is far more important than trying to optimize anything. The whole point of this setup is that it can run in the background without needing constant attention. I'll continue to share regular updates so we can see how this develops over time, especially through different market conditions. For now though, I'm happy to stay the course. So to wrap this update up, here are the key takeaways. First, even relatively small contributions can add up. Between the initial £100 and £25 per month, we've invested £250 in total, and after 6 months, that's grown to £271 and 36 pence. Second, the short-term performance will always vary. Some months were strong, one month was slightly negative, and that's completely normal when you're invested in the stock market. And third, consistency matters far more than trying to time anything. So far, this junior ISA is broadly tracking in line with the long-term plan, which is exactly what I want at this stage. For me, this just reinforces the idea that a simple, low-cost, long-term approach can work well, especially when you're investing for a child. So that's where this junior ISA is after 6 months of investing £25 per month. I'll continue to share regular updates on this portfolio so we can see how it develops over time. If you're also investing for your kids or you're thinking about starting, feel free to subscribe so you don't miss the future updates. And if you found this video useful, a like really helps the channel and lets me know to keep making this kind of content. Thanks for watching, and as always, keep it simple, keep it realistic, and keep it effortless.